whether or not there's a $100 price target, I think we'd be somewhat sceptical about that as an explicit thing to focus on. But if we step back and look at the underlying structural dynamic in the market, the real problem from Saudi Arabia's perspective is that at any price, not even close to their fiscal break-even, any price around where they might target it, you're going to be in a scenario where non-OPEC supply is going to grow faster than trend demand growth. And so while that's the case, it's very hard to find an equilibrium in the oil market. And really what you need to do to get to an equilibrium price, therefore, is to go down to a level where you can see those two supply-demand dynamics on an underlying basis match up. And our view for some time has been that that's probably in the 60s. That's not in the 70s, certainly not in the 80s, nowhere near 100. And in a sense, if we just, rather than looking at the specifics of that article, we just think about that broader backdrop, I think there's a bit of an acceptance in the market that that's the case. And that does mean structurally it's hard to be bullish on oil in terms of fundamental balances, unless, of course, you do get something like a meaningful supply disruption that changes the game.
Plug some geopolitics into that for me. What's geopolitics worth, do you think, at the moment? So 60 is the base case. What do you plug in on top of that?
I think at the moment, in terms of the geopolitical risk, it's getting very little risk premium in the market. But a big reason for that is fair is that because of the OPEC Plus cuts, there's quite a lot of spare capacity. The evident risk, I think, if we look at how the market has priced out geopolitical risk premium since, for example, Russia's invasion of Ukraine didn't deliver any meaningful supply disruptions. What happened a year ago in the Middle East hasn't led to any subsequent supply disruptions yet, means that is potentially underpriced from a shorter-term perspective. And so if you did lose a meaningful amount of supply in the short term, say 1 million, 2 million barrels a day, yes, there's spare capacity in the market, but would that actually tighten things up a lot in the short term? And could you get some fairly dramatic price action because the positioning is also very short? That is clearly an asymmetric risk in terms of shorter-term dynamic.